What's going on, guys? Welcome to Stock Talk with Nico Criticos. Today, we're going to be doing some stock analysis for Symbotic stock because the stock is now up over 17% today after it looks like they are expanding their partnership with Walmart. And it says that this could expand their addressable market in the US by more than $300 billion with a B. And so this could be a huge move. If we look at the past year for this stock, it's been kind of all over the place, not a great, definitely an underperformance of the general stock market, but there is some good things happening with this company. So this is little over an $18 billion company. Last couple of years, revenue trend has been strong, going from 250 million 4 years ago to now 1.8 billion. So they've done a good job with that. Net income was negative for a long time up until last quarter when they did $25 million in the bottom line. So that's pretty good. Cash to debt ratio is looking very good. 700 million in cash with no debt. That's very good. The bad part is that their shares outstanding has been increasing rapidly. 2022, they had about 50 million. Now they have over 100 million. So just in the last 2 years, that will cut the stock price in half just with that. And that's probably a large reason why we see the stock trading down so much because really from 2022, I mean, see, so okay, here's where the stock was at its peak, right? $56. Really, they've made a lot of improvement since then. So the stock should be higher, but since they've issued all those shares, that's not going to help out investors. So let's look at what analysts have been doing. Unfortunately, now this could also be a big reason. EPS was expected to be down a lot from 1.1 to 0.3. That's a big reason the stock will come down too. But the good news is that next year, it's expected to double back up to 0.6. And then we're looking at 25% revenue growth expected into 30% revenue growth expected. So those numbers are strong. And so there's good things and there's bad things. The balance sheet is good. The shares outstanding is bad. It's a very good sign that they're now profitable. That's a huge thing. If that quarter wasn't profitable, I don't know if I'd be interested in buying the stock. But really, right now, I'm somewhat interested. I don't know if I'd buy. I'm not super eager to start buying right now because the valuation is pretty high. I mean, they're going to do 0.6 in EPS and you're paying $31 a share. That's a lot. So after this big jump today, I'm not sure this is a good time to invest. Forward PE of 131. Now that might be, I'm not sure how up to date that is, but still, these numbers are huge. And so I wouldn't, it's not, I mean, if they're growing 25, 30%. That's great, right? And actually EPS is going to double. But again, it's very all over the place. It's not, remember, they did over $1 last year. So it's very all over the place. And I just wouldn't want to be paying 100 times earnings for a stock. But I mean, this deal with Walmart is huge. And so that's a great catalyst, a great sign for as far as the business goes. But as far as the valuation and an investment, I don't think it looks super attractive right now. So that's my only thing. If the valuation was to come down a lot, then maybe I'd be interested. But $18.5 billion for a company that just did 25 million in profit, I don't know about that. So that's my analysis for this one. I mean, this is great news for the company, so I could see a bright future for them. It's just, how Warren Buffett says, you don't want to overpay for all the, even if it's a quality company, you don't want to overpay. So you just got to be careful with that. But that's all I have for you today. Thank you for watching, and I will see you in the next video.